Hi class, the purpose of this video is to go over some of the key points that we've done in the last couple of weeks on how to record cash transactions and report profit. It's not going to be an exhaustive video, but it's going to cover a number of the key points that will get you ready for your SAC and to begin your revision process. So what are the key things that you need to know in this topic? This video will cover how to record cash transaction reporting and report profit, and these are the important points that we want you to leave this video understanding. 1. How to identify cash receipts and payments. 2. How to record cash receipts and payments in journals. 3. How to create a statement of receipts and payments. And these are the three main things about how to record cash transactions. We then move on to reporting profit, and we should be able to identify revenue and expenses and hence calculate profit and create an income statement. So we will have a slide of each that will go over the key points of what you need to know for that point so you can achieve the learning intentions. So how do we identify cash receipts and payments? The first thing is we need to know what they are. Cash receipts are inflows, that is the key word, of cash received from individuals or businesses. If cash receipts are inflows, it makes sense that cash payments are outflows of cash paid to individuals or businesses. So receipts, inflows of cash, payments, outflows of cash. And there are a number of situations where we might receive cash or a cash receipt, or pay cash or have a cash payment. For example, cash receipts can come from cash from selling goods, interest received, so we get interest from one of our investments. We could sell an asset, collect money from accounts receivable, so a credit customer finally pays us back. We can get cash from providing a service if we're a service business. We could take out a loan, so a loan's taking out, which even though it creates a liability, we still get money from it. Or there could be capital contributions, and we know capital contributions are when our business owner provides cash to our business. Common cash payments include buying goods for cash, paying interest on our loans, buying new assets, paying cash to accounts payable, so paying our suppliers when we first purchased on credit, paying expenses, repaying loans, and cash withdrawals, which you also know by the term drawings. So we need a way to record these cash receipts and cash payments. How do we do this? We record cash receipts and payments in journals. Cash receipts are recorded in the cash receipts journal, not a very original name. I bet you can get, so the next one is cash payments are recorded in the cash payments journal. But before we go to that, let's have a look at the cash receipts journal. You are going to become experts at creating things like this. This is a journal that summarizes all the cash receipts that we have created. It's called a multi-column cash receipts journal. In the columns, we will put the date, the detail, and always put the source document. So this could be a receipt, the most common source document for cash receipts, or electrical fund transfer is the EFT. So we've got this information from our bank statement. We're then going to say how much money has been banked, and what that means is how much cash we've received, and then we're going to split it up into and find the column that best represents how we've received that cash. If it's a common transaction, there will be a column for it. If it is a non-common transaction, there won't be a column for everything, so we put it in the sundry receipts, sundry meaning uncommon, and the detail becomes really important. So if we look at September 1st transaction, that's in the sundry receipts column for $9,000. What was that for? Capital. What do we mean by capital? If you remember the last slide, our business owner has given cash in terms of a capital contribution. At the end of the month, at the end of the period, we'll tally up all our columns and in the total section, totals row, and the amount banked, in this case 16,510, should equal the sum of all the other columns. And if you pause this video and got your calculator, you would find out that the 5 columns equal 16,510. Cash payments are recorded in the cash payments journal, and it looks really similar and works the exact same way. We are going to total up the total pay, write the total paid in the total paid column, and then separate that amount of money paid into the column that best represents it. Common payments have their own column. Uncommon payments go in the sundry payments column. So for example, the $250 that was paid, $275, that was paid on the 5th of September. If you look at that one, that was due to a sundry payment of $250 plus GST, and that sundry payment was advertising. And again, at the end of the month, we sum up all the columns to work out how much has been paid, in this case, $4,560. And if we sum up the totals of the rest of the columns, that will equal $4,560 because it represents the breakdown of how much has been paid. And this is a good final check when you're recording cash receipts and payments. Once we've done that, we have recorded all our receipts and payments, but we want our reports to make sense and be easily understandable by our business owner so we can give them good advice and they can understand it. We can do better than these journals. We make a report called the Statement of Receipts and Payments. The Statement of Receipts and Payments is an accounting report which summarizes all the cash flows for a given period of time, and it looks something like this. And I think you can all agree that this looks much more clear than the two journals. It is, though, the exact same information. It should show the totals for cash receipts and cash payments, like it says here. It has totaled all the cash receipts first. They've got all that information from our cash receipts journal, and then all our cash payments, which we got from the cash payments journal. So it shows the totals of cash receipts and cash payments. And then importantly, it tells us whether we have an excess or deficit of cash. In this case, we received $16,510 of cash and paid $4,560. If we now then know that we have received more cash than we paid, so we have an excess, and that excess is $11,950. We should be able to then work out the expected end bank balance by finding the starting bank balance. In this case, there was nil, and plussing the excess or minusing the deficit. So in summary, this creates a more clear, more understandable report so we can analyze cash. We know cash is super important because it's how we pay our debts, and it's really important to liquidity. What's the process that we follow if you are given a number of transactions? Number one, categorize them into cash and non-cash. I recommend putting a C next to the ones that are cash and an NC next to the ones that aren't cash, and you ignore the non-cash ones. Non-cash transactions don't go in these reports. You will then categorize cash payments into a receipt or a payment, and then you'll create your statement of receipts and payments and maybe record in your journals prior. And that's how you really accurately and quickly record cash transactions. We now move on to how we work on profit. Remembering profit is different to cash. And the key thing with profit is how we identify revenue and expenses. Why is this really important? Because these are the inputs that go into our calculation of profit. Profit equals revenue earned, and the earned is important, less expenses incurred. This means that we will look for all the revenue that has been earned in a period and all the expenses that have incurred in a period. There is an important definition of revenue, and it's important that you understand that not all receipts are revenue, because there are 3 things that need to be ticked off for something to be revenue. Revenue is an inflow of an economic benefit, so you need to have an inflow of a benefit. It needs to result in an increase in assets or a decrease in liabilities, almost always an increase in assets, and an increase in owner's equity that is not capital contributions. If you tick those three things off, it is revenue. If you don't, it's not revenue. So you can have a cash receipt. For example, taking out a loan results in cash increasing, so it was a cash receipt, but it's not revenue because while it is an inflow of a benefit that increases the assets, increases cash, it is not an increase in owner's equity because our accounting equation is balanced by the loan going up. An expense also has three things that need to be ticked off. All three need to occur for it to be an expense. So again, not all cash payments are expenses. An expense is an outflow or consumption of an economic benefit that leads to a decrease in assets, that leads to a decrease in owner's equity. Again, all three need to be ticked off. And if you see the drawings are never an expense. Once we've identified all our revenue and expenses, we then create the income statement where we clearly, in a clearly understood report, show our profit. The income is an accounting report that summarizes all revenues and expenses for a period of time and reports profit. And it looks something like this. Again, really clear, $4,100 of revenue worked out first, and then we've lessed all our expenses, $2,950, so we made profit of $1,150. And if you remember from the start of the video, this is the same business as the statement of receipts and payments, and you can see there's a big difference between the amount of cash we made, almost $11,000, and profit, only $1,000. So the income statement will show totals for revenues, expenses, and profit. Remembering profit is revenue minus expenses. How do we work this out? A similar process to statement of receipts and payments. We will categorize cash items into revenue or expenses and put an R or E next to them, and then you'll create your income statement and calculate profit. But before you move on, be careful, not all receipts and payments are revenue and expenses. And just as importantly, if the expense has been incurred in the period, it counts as an expense even if it hasn't been paid. So a simple example might be we have a telephone bill for $120, but $50 is still owing at the end of the month. So our cash payment for telephones is $120 minus $50 because we haven't paid the $50 yet. So our cash payment for our telephone is $70, but our expenses that have been incurred in the period are the full $120. And guys, that is a summary of how do we record cash transactions and identify revenue and expenses and report profit in the income statement. Keep studying hard and you'll be an expert when the SAC comes around.